Hello everyone, welcome to Right Views. I'm Rahul. Today we'll be discussing about the market implication of the coronavirus crisis. This crisis is fundamentally different from the crisis that we have experienced in the recent past. The crisis that we know of have initiated or started as a financial sector shock, and they have translated into an economic slowdown in the real economy. In such crisis, the macroeconomic policy is able to address the economic slowdown. How fast the economy recovers, the real economy recovers, depends on the speed and the intensity of the macroeconomic response. The coronavirus crisis, on the other hand, is a real economy shock which will impact the financial sector, and the financial sector shock that it will create will in turn impact the real economy. Markets as yet have not considered this fundamental difference. In fact, at this time, there are 6 forces that are acting on the markets all at once, and not all of them are understood. Let us look at those right now. The first important force that we are going to talk about is the fundamental economic slowdown that was already underway even before the coronavirus hit. Now, the global economy, particularly the consumption engine of the economy, has been at its peak in the 2017 to 2019 period. In fact, the US reached its economic height in the last year. It has reached full employment, almost full employment, and the interest rates at this sort of economic activity have been the lowest ever. While these short-term dislocations are taking place, there are also fundamental dislocations already happening in the economy, particularly in the consumption engines, that is the developed world. First is the population decline, which has been happening over the last few decades. This population decline means consumption in these economies will go down, and it will have an adverse impact all over the producer world, which is Asia and particularly India. Further, as these workers retire, they will move from producer status to a dependent status in the economy of the developed world. Now, this will put pressure on the pension system and also healthcare system. Both these systems need reform right now. The second force is the virus itself. Now, the nature of the virus, its spread, its impact on the health system and the public health system has not been completely understood. At this point, what we understand that it is a supply side shock with a demand side impact. The only way is to shut down economic activity to stop its spread. Now, we also understand to a certain extent that public health crisis is going to be the result of this spread, but that implies longer and stricter quarantines, which means a deeper economic slowdown, and this lasts till June of 2020 in the best case. The third force is the impact of the feedback loops that is generated because of the virus. There are 2 sets of feedback loop acting on the market, as can be seen in this slide. Now, first set of feedback loop is the economic impact, which is transmitted from the Chinese supply shock, and it results in a demand shock in Asia, in Europe, and in the developed markets. Now, this is going to translate into a demand compression or a demand slowdown over a prolonged period. But on top of this is also the virus feedback loop, which moves from the Chinese origin of this virus, and it moves across the developed towards the developed economies, resulting in a shutdown and restriction on global activity across the developed markets, which are the consumption centers of the world. The fourth important factor acting on the markets is the fundamental dislocation already existing in the financial world. Look at this slide. Post 2008, too big to fail institutions, which were at the heart of the 2008 crisis, have become even bigger. Banks, that, however, are in better shape, but other financial system isn't. Low yields across the spectrum have pushed investors into riskier assets. Passive investing strategies have chased momentum, but this momentum goes both ways. Algorithmic trading and high frequency trading are amplifying market moves. The signal from the repo market in 2019, which is the lack of quality collateral and lack of availability of bid ask on certain securities, is triggering a financial panic. While financial system is vulnerable, corporate sectors too are vulnerable, and that constitutes another force acting on this market. Look at this slide. Corporate debt to GDP has increased dramatically. Corporates have used cheap debt to amplify the return on equity, leaving them vulnerable to higher interest rate even before the virus struck. Now, higher interest rates make the corporates vulnerable because they demand extra cash flows. At this time, because of the virus, the cash flows are going to zero. Earnings are going to zero, cash flows are going to zero. Now, there is a very dire consequence on the leveraged corporate sector because of this. This means corporates won't be undertaking investments and expansion of capacity anytime soon, which leaves the economy further vulnerable. While this was not enough, the demand destruction caused by the coronavirus crisis resulted in a steep oil price decline. This opened up a window of vulnerability, and in this vulnerability there started a price war between OPEC and Russia. This price war now feeds into the feedback loop as high-cost shale producers' debt gets classified as junk. This is adding unnecessarily an additional stress point to an already fragile system. And that is the reason markets have crashed. In the past 1 month, markets' major indices have lost more than 35%, and they continue to lose drastically. While oil remains at its low and it seems to be going lower, the US dollar is rising. To compound the problem, the policy response that we have seen is tangential to what is required. A big crisis now may become bigger crisis if financial plumbing comes apart, just when the world is ready to recover from a virus shock. Central banks must fix this plumbing. Coordinated global action across the central banks will be required. Instead, they are busy trying to tempt consumers into spending more or trying to tempt banks to lend to critical institutions. This kind of policy response does not inspire confidence in my mind. At this stage, I think there is fundamentally a lot lower for the markets to go, and bottom fishing at this stage is not desirable. We'll further discuss potential policy responses and potential market actions in further videos. That's it for now. Thank you for listening. Please do subscribe and like this video. Subscribe to our channel and follow us on Twitter and Instagram at these handles. Thank you very much for watching.